Good evening, everyone, and welcome. Hopefully, we will be getting everybody in the room here in just a moment. Looking forward to sharing with you this evening some thinking outside the box techniques to get you all involved in some more real estate. So we will get this started here in just a moment. I'm seeing a lot of you joining us from all over everywhere. This is being recorded this evening, so if you would like to catch it later,
Okay, so
going to be on my YouTube channel, social media feeds, and all that good stuff. So we're going to give you get from. And if you would not mind, just at least to start, to mute yourselves. And then that way, if we have questions at the end, we will absolutely have time for Q&A and all that good stuff this evening. All right. Well, let's go ahead and get going here. Hello, everyone. Good evening. This is Nick Liebert with EXIT Strategy Realty, along with a lot of our friends and neighbors across Chicagoland this evening. This is Creative Financing 101, and we are going to be talking this evening. It's actually part of a series we're doing for you to open more doors to not only just home ownership, but property ownership, because we want you to have the opportunity to have multiple income streams, residual income. That's why we're here as a company unique within even the brokerage community. So we're very excited to have all of you with us tonight, and the series that we're going to be talking about not only this evening, but again on Wednesday, is again opening doors to more properties for people of all different walks of life, of all different communities and all different interest levels in real estate, whether you're looking to buy a building, buy your first home, buy a condo, a piece of land. There's so much opportunity out there because real estate over time almost always appreciates and can be done, can be transferred and willed and create a legacy with it. So there's just so many different things you can do with real estate, and we want to get it in the hands of as many people as possible to empower them. So I'm going to go ahead and share my screen here to start this evening. Nothing on these slides tonight is not shareable. So in other words, if you want to go ahead later on and share any of this with a friend, feel free to do so. This, again, is being recorded this evening. So why are we here this evening? Well, I'm glad you are with us because we know that right now, I've taught this class before. Some of you may have seen a few of these slides before, but not the way that we're talking about it this evening. We used to say when a mortgage isn't an option for you, you might want to think about creative financing. Well, now we're saying this is when a mortgage isn't an option or your best option right now. So I'm going to go ahead and mute a few of our friends that are unmuted. If you are just joining us, please go ahead and mute yourselves. Thank you so much. And so what we're saying that tonight, knowing that interest rates are at levels that just are not that attractive based on what we've known for the last, 12, 13 years, artificially low rates, record low rates, 2.5%, 3.5%. We don't feel like those are going to be the rates that we see maybe ever again. But we know that the current rates approaching 8% in some cases, they're just not that attractive. And we know that that's not going to necessarily change, and they're not necessarily going to go down anytime soon. So what we wanted to open the door up tonight to was a conversation about creative financing, not just for people that have some credit issues or that maybe are buying something down the road and they want to reserve the right to do that now. We're saying, hey, you know what? Let's try to get some folks locked into a price because we believe that prices are continuing to appreciate. We know that rents are continuing to go up, and we want to try to help more people build an equity position, whether that means you are getting a mortgage right now or you are doing something else right now, like a lease purchase or a lease option. We're going to talk about a lot of different options and ideas tonight. So this is, again, a two-part series. The first piece is tonight. Tonight is meant for whether you are not able to get a mortgage today or you are not that excited about getting a mortgage today. That's going to be the conversation we have this evening. And then we're going to come back again together on Wednesday evening. And this was not originally meant to be a two-part series, but it just happened that we had a great presenter and topic set up about low money down, rehab loans, about grant programs. And we were going to put that together. And I'm like, wow, that's the other end of this equation. Because we really, if we're going to be breaking down barriers to property purchasing, homes and beyond, we've got to figure out what the issues are, right? So let's start with this question. What's holding us back? Now, I'm looking over here to my right and I'm seeing some, I don't think anybody's got their camera on. That's okay. I've got mine on. Hello. But I see some familiar faces, some faces even from our office. And maybe you're like me. Well, maybe we've got some property. The home that I'm living in, I bought as a foreclosure back in 2012. It was literally one of the best real estate decisions I've ever made. I've made some really bad mistakes too. We're going to talk about one of those this evening. But all of us on here, maybe it's your first home, maybe it's going to be your 10th property. What is holding you back? What's holding you back from that next step? And so we start with the question, what specifically for us is holding us back? And there's really only four things I could think of looking at all of my clients, the clients of our agents that I coach every day, of the people out in the community that I speak to. And those four reasons are the following. Number one, commitment. And this is not a lecture. I'm not going to sit there and tell you you're a terrible human if you want to keep renting forever. But I really want to tell you a story quickly about if you're not committed, if you don't see the reason or the importance of purchasing, what can happen to you, because it actually just happened to me. Now, you know that I said that I've had this roof over my head since 2012, right? Bought it with EXIT Realty residuals, one of the best purchases I ever made. What did I not buy? For those of you that know me personally or that know our office, I said the same thing that so many people have said over the years when they say, I'll do that another day. I'll buy another day. I'll do it later. I'm not ready. I'll wait for blank to happen. I'll wait for prices to go down. I'll wait for interest rates to go down. I'll wait for there to be more housing stock or more properties to look at. I just don't have time to look. And then obviously the thing that some of us say sometimes, well, I'm not sure how long I'm going to be here. That one, I gotta tell you, that probably is a good excuse. If you don't know you're going to be on, in this area that long, maybe you don't buy right now. But for the rest of us, you're putting down roots, or you know you're going to be here for at least a bit of time. Don't do what I did when I signed a lease on my office space over on North Avenue. Very nice space. We were in it over 12 years. I never intended to stay there. Kind of like some of you have said, I didn't think I was going to be in that apartment that long. And then 2 years goes by, 3 years goes by. The excuses that we make to ourselves, I'll do it later, I'm not ready, prices will go down, I'm not sure what I want anymore, etc., etc. And as I took the last box, actually, to be honest with you, some of our staff took the last box out of our old office space on North Avenue, and I went back over there to take one last look to make sure we hadn't left anything after 12 years in there. I realized I'd paid that nice landlord over $1 million in rent. Now, that's an extreme case. That's an extreme case over 12 years and a big office space. But man, don't I wish I could go back and say, I'm going to put a stop to this. I'm going to go buy a little space. Maybe it won't be perfect. Maybe it won't be my forever office home or my forever primary residence for those of you that this is your first purchase. But I just can't believe that I made the excuse to myself and I got busy with other things. And then I waited for things to happen that never did. And I turned around and I looked at all that money down the drain. Who's got a great equity position now that's had their mortgage paid down? That landlord. I've paid that landlord's mortgage. I've set that landlord up for retirement. Very nice person, but I should have done that for myself. And I own a home, but I rented my office space. What are you renting that you should be owning? So commitment is our first thing that can hold us back. And so probably that's not anybody on this line today. You're sitting here wanting to learn about creative financing because you are motivated. You're committed to this process. So that's not for us, but it is maybe for our neighbors and somebody else to say, hey, you know what? You don't have to keep renting. You can break this cycle. You can do better. You can do more for you and your family. Don't do what I did. Second step, second roadblock, credit. Something needs to be fixed, remedied, paid off. Sometimes that can happen, not overnight, but in 90 days. We've got some great credit repair people that we can connect you with if that is your main roadblock, that's your main barrier. But that sometimes takes longer than that. Maybe you've got a bankruptcy, you've got a foreclosure, you've got a fraud on your accounts, and you've got to clean that up. That could take a lot of time. That could take years sometimes. Do we want to, though, set ourselves up to have a reason to clean that credit up? Do we have an end goal, or are we just doing it so that someday we may get something better for ourselves? So this is a great reason for tonight's segment. Is creative financing is meant for people in some cases that they've got a little work to do on their credit. But do we want to just wait like me and say, well, I'll do that later. I'll buy when I'm ready. You don't need to buy today. If you use creative financing, you could lock in your price today. We're going to talk about why that's so important in a second. Your third roadblock or the barrier that's holding you back is probably going to be, for some people, income. And I don't mean income in terms of I don't have a job. I mean income in terms of maybe you are W-2 and you used to be 1099, an independent contractor. Like so many of us realtors, maybe we have been in the business or a business less than 2 years. How many of you are in the gig economy or have started a business or have expanded to a new type of business? Maybe you were a W-2 employee before and now you have started your own business. That may mean you need some time, could be up to 2 years or more, depending on the lender and the situation, to establish that income history. Not the tenure, not the job type, not the payment type that you need. That means that, guess what? You are waiting. Again, we're going back up to that, of those other two things. We're waiting. It's a waiting game. Do we want to wait? Or can we lock a price in now using some creative methods? So income. And that, by the way, does not mean that you have to have a job in some cases even to purchase certain types of property. If it's an income property, there are loan types that, as long as you've got the credit score, if that property cash flows and you have the down payment, you can buy that property. There are basically, they've got to be sustainable properties that they can pay for themselves. So don't think that income is the only criteria there that's going to be a benefit. That if you have a job, you can buy some property without a job if you've got certain type of property in mind that's cash flow. So income, though, does hold some people back. 4 is the most obvious one for a lot of us, and that's money. And now this all sounds like money, right? But I mean down payment and closing costs. The money, the skin in the game to get this going. If I've got decent credit, I've got a job, or I found a property that is sustainable on its own in terms of making its payment, what is the other problem? I don't have the money down. There has been a change in conforming loans that is effective in November that will allow you to buy a multi-unit building as a primary residence for 5% down. There are 1% down loans right now. It's 3%, but 2% is a grant. There are grant programs out there for various areas. various, maybe you've got a occupation going back up to the income. You've got a job that is in a certain category that they're trying to help, like the doctor loans. You've got some grants for teachers. There's all different kinds of incentives out there if you know where to look. So the money equation, don't think that you need a lot of money. It makes it a lot easier, doesn't it? But that should not be a roadblock or a barrier. If you're thinking you don't have the money, please do yourself a favor. If you've got a commitment and you've got decent credit or in the process of fixing it, and you got an income of some sort, don't decide arbitrarily that you don't have the money to buy. Because there's even a program now that if you are on housing voucher, on certain housing vouchers, you can actually buy a property. It's one of the most exciting things I've seen for some of our friends that are in the voucher system. Really a great program to break that cycle and break down the barrier to home ownership for people that never would think that they are able and capable of doing it. They can do it. I've actually we did that training a couple months ago. It's on our YouTube channel. So money does not need to be a barrier. So the second part of this presentation is Wednesday, and that's part 2. It's in person. We will hopefully get a recording of it for those of you that can't make it, but we're gonna have a little fun. We're gonna have some food. We're gonna have some libations, and we're gonna learn about all these low money down grants, the rehab loans. You know, you come in and you walk into a property and you go, well, I mean, I maybe qualify for a loan, but I can't live here. Yes, you can. You can get money to help make that place whatever you want it to be. There's incredible loan products out there. These interest rates may not be great, but the innovation of some of these lenders has been extremely great. So that is what Wednesday's about. Text EXIT Strategy Events, all one word, to 85377, and you will see that event just like you did tonight. So we would love to see you there. It's going to be a wonderful time. So, okay, we've decided that we've got some barriers we can overcome, right? What are the drawbacks to creative financing? Now, why would I start with this slide? Because I like to just lay it all out there. I like to be transparent. I don't want to overpromise and underdeliver. I'd rather just say, okay, here's the drawbacks. For buyers, you're going to find some sellers are less negotiable on the purchase price with creative financing than if you are going to walk in there with cash or a mortgage. Because guess what? That seller is not necessarily getting their money right now, right? It's creative financing, lease with option, lease purchase. That seller's not getting all their money right now. So they're probably not as excited to give you a huge discount on the property. But lock in that price today versus waiting and hoping something else changes in this market may be smarter to just go ahead and say, okay, this is a reasonable price. It's not the best price in the world, but it's a reasonable price and I can lock that in versus hoping and waiting for something else. Now, if that's for the buyer side, that's the drawback. For sellers, again, just like we said, it doesn't allow you to cash out, not yet. And it means you could still have liability. Maybe you'd have to foreclose or get eviction to get those people out of the property if they do not commit and honor their commitments to this process. In other words, that they don't make their payments. So there are some drawbacks. There's some caveats there. And everybody, including all of us in the real estate industry, we got to be patient and we got to be creative because this is not instant gratification. Really, nothing in real estate is. Real estate is not get rich quick, not get rich easy. It is a buy real estate and wait, not wait to buy real estate, but you don't buy real estate and tomorrow become a billionaire. That is a lie. So everybody's got to be patient, a lot of good communication and a lot of understanding because not everyone's going to understand on the front end how creative financing works. So we're going to hopefully get some information out tonight and then have those conversations start in your local communities and with some of these potential sellers and buyers. So what we're going to talk about next is the history of creative financing. How did it come about? Why don't people just get mortgages? Well, how did people start getting mortgages? People couldn't afford to buy a property cash anymore, a lot of them. So the history of creative financing It really became common during the wild interest rate heights of the early to mid 1980s when interest rates were at 18%. And the ironic thing is that when I was teaching this class, the first probably decade that I've taught this class for a long time, but because I bought and sold properties using creative financing over the years, sometimes myself, as well as done it for clients. But I always taught this class saying, well, that's how it started, but nobody's doing it because the interest rates are high anymore, because the interest rates haven't been high in so long. Well, now we're coming back to creative financing, not just for people that are not able to get a mortgage right now, but what did we say on that first slide? That maybe it's not the best thing for them right now. So obviously, people with some credit issues, if there's a restriction on lending, we saw a little bit of creative financing during that freeze in bank financing during the Great Recession of 2008, 9, and 10. And this also is particularly attractive or potentially attractive for somebody that's got a hard to sell property. It's maybe hard to finance due to the condition. Maybe there's something, with that property that most banks don't want to lend on. Well, maybe that seller will do a land contract. And entrepreneurs with hard to pin down income, people that want to buy a building but don't have the experience level to do a big giant, like maybe a fix and flip, that a regular financing would work on. Creative financing could be an option. So what are the types of creative financing? So let's go ahead and say, why are we here? I want to make sure that I did not miss a slide there. There we go. History of it, the drawbacks of it, and why are we here? Obviously, it's a solution for people with low credit scores. You can get a seller a marketable price when they do not have a marketable price on selling it a traditional way. It does, especially, this is what we're excited for tonight. It allows you to build an equity position as a buyer without closing on the property. We're going to show you how that works in a bit. So, in other words, if I can lock in a price today, even if I can't close today, when I say close, I mean I get the keys, but then also the seller gets a check and they walk out. They're gone. If the seller's still in the picture, how do I get an equity position as a buyer? That's what we're going to work on today. But what we are seeing, we're going back, and I want to pop back in that one slide about the history of creative financing, is the wild interest rate hikes of the early 1980s. Guess what happened? That is when people sat there and said, well, wait, I think that we're in this high interest rate thing for a long haul. Nobody was selling because they didn't want to go anywhere and pay these terrible interest rates. They didn't have anywhere to go. And so guess what happened? Kind of similar to this market. Very low inventory, very little movement, a balanced, stagnant market. The prices just kept going up. So rents kept going up. And that's a whole different conversation, but rents kept going up. And prices kept going up, the market value of the properties. So somebody that waited for the interest rates to go down was paying so much more later on. And I saw a really good number earlier today, and I'm going to read this to you. I would have loved to have gotten the time to get it into a graphic, but I found it at just the oddest time this morning. I thought, wow, that is exactly what we're going to be talking about tonight. And what it said was, okay, if I buy a property now at $500,000 purchase price and 7.5% interest rate, the dollar amount monthly I'll pay is $3,780 a month. Okay, well, what if I wait till the interest rates went down to 6%? What do we know is going to happen? Prices historically in a balanced, stagnant market like those early 1980s, they continue to go up. So if that $500,000 property at 7.5% interest rate had a payment of $3,780, later on that property at $600,000, because you waited and the prices went up as they have been known historically to do in a balanced stagnant market. Oh, my interest rate's 6%, but on $600,000 at a $500,000, my payment's $3,930 a month almost $200 more a month. So I am paying more on the front end, and I'm paying more every month. And man, look at an amortization table as far as what you're going to pay all the time in between. You may not even be able to afford that additional $200 a month. So that is really scary to me. If we are going to be in a balanced stagnant market for several years, like some people are talking about, that could be really very, very expensive for everybody. So we want to potentially build in buyer equity. I did see a question come up. I am going to, yes, Cassandra, when the rates go down, everyone will enter the market. There was a hilarious meme the other day where someone was like this, the minute rates go down 1% and they sound like bees swarming. And I thought that is going to be an insane moment. And, I'm telling realtors, I'm like, hold on, when that happens, it's going to be a great market for you, but it's also going to be chaos. Kind of like when the interest rates went to 2.5% and 3%, we saw everybody running out, and what happened to the prices. So great point, Cassandra. Why are we here also? Item D is important to me. It allows those with an improving situation to work towards a goal early. I just said earlier, real estate is not instant gratification, but it would be great if we had some way to kind of start to get the benefit of real estate while we are doing the hard work. If we've got to clean up our credit, we've got to be on a job longer, et cetera, in order to qualify for a regular loan. Let's go ahead and get some benefit of this now. So what are those creative financing types? Glad you asked. There are 4 big ones, and then there is maybe a 5th, and that's where we're going to have our friend Shaheen talk to us a little bit about. It's not really creative financing in terms of the seller holding the note, but the seller is going to do something for you. And so we're going to have Shaheen come on at the end and just talk to us a little bit about what you can do in that strategy. But the main 4 things we're going to talk about today is a land contract, purchase money mortgage, a lease purchase, and a lease option. We're really going to focus on lease purchase and lease option, but also contract for deed or land contract. Right of first refusal or an option contract, that's another thing we can briefly discuss as well. But before we go any further, it's important to note, where do you find those properties? This is a emerging topic for a lot of people. This is not something that people have been teaching outside of like some really kind of interesting investor classes for many years, because we didn't have these interest rates where you needed to do this. So a lot of realtors don't understand it. A lot of sellers, a lot of property owners don't understand it. A lot of clients don't understand it. What we need to do then is do twofold. Number one, if a property is sitting on the market and you see the market time and it's extensive, it's a long market time, you should be having a conversation potentially with that owner to say, hey, have you thought about renting it out, but creatively renting it out? I don't mean just a regular lease. And if the property is already for lease, what do you think you should do? If it's for sale and for lease, that's a hint that somebody's willing to do either. That would be a great property to present a lease purchase or lease option as an option on the property. So there's also an additional field in the MLS, at least our local MLS. This is a Chicagoland class that I'm teaching tonight for MRAD. Or not for MRAD, but MRAD is our local MLS. I'm not an MRAD instructor, ladies and gentlemen, not at this point. But we like all our friends that are. You would, as an MRAD user, realtor friends, you would be looking for that additional field, sale terms in the MLS, to see if there's an agent or a seller that already knows about creative financing, is already willing to do this. There has been literally many times in the past 6 months that I've seen on some commercial properties, all of a sudden land contracts have started to, in the additional terms or even in sometimes the broker notes, they're making some notes about this could be assumed, or this could be transferred, or this could be, this could be a land contract or an installment contract. So look that additional field up. And if you are with us as an agent or as one of our clients, our valued clients at Exit Strategy, we have Zenlist. That is an app. It's an amazing app. That app has not only private listing network listings, it has for sale and for lease. So if you see something for sale and it's also for lease, you know it could be an option. Or if you just want to look at properties that are for lease or for sale and say to your Exit Strategy Realty agent, hey, I'm finding these, I'm marking these, either as sale or lease, and I'd potentially like to see if this would be an option on that property. This would be something that the seller or the property owner, I should say, would consider. So the Zenlist app, we don't just set you up in a regular MLS search. We get you the private listing network listings through a Zenlist, and we go out and we also give you the ability to set your own filters. You can look for sale, for lease, for residential, commercial, investment, all of that. So don't think that a traditional MLS search is what you need. You need Zenlist, and that's what we provide at our office. Less than 1% of Chicago realtors and consumers have that app. It's an amazing app. So make sure to reach out to your Exit Strategy Realty agent if you don't already have access to that app. So Cassandra, remind me, I will look at that question at the end. I'm going to keep going for now. All right, so let's discuss lease purchases. So lease purchases are pretty much the same as a regular lease, except there is a purchase contract in there on the back end. And what I mean by that is there's a contract to purchase for a set amount at a predetermined time in the future. I'm going to rent it from you now. So there's going to be a traditional lease, a lease or rental agreement. I'm going to rent it for you now with this agreement. And then I'm going to also say, and at the end of this lease or at a specified time in the future, I'm going to purchase this property from you for XYZ dollars. So it's very, it's not only formal, it's formatted in terms of there's a price, there's a term, there are details. It is not a universally standard contract, but there's normally a lease on the front end and a purchase agreement on the back end. And there's somehow an addendum or a document in between that says, I'm going to lease it from you now. I'm going to purchase it from you later by this specified time for this set amount. I'm locking that in now. I'm going to lock that in now. So that is a lease purchase. A lot of times with a lease purchase, that means that you as the tenant for today, waiting for interest rates to go down or getting that credit cleaned up or waiting for that second year of employment with the same pay type, whatever that situation is, you as a lease purchaser are going to most likely have a deposit not only on the lease, but you may have some sort of payment holding this purchase. In other words, if you do not purchase the property, there may be a repercussion against some deposit. That is something, it's a little bit more, there's a repercussion if you don't buy. You're going to lose something if you don't buy. Maybe all you lose is that potential equity in the property, but it's not an option. It is a contract to purchase. And they're not normally hugely punitive in damages if you don't purchase the property at the end, but there's going to be something because that landlord slash owner of the property and you went to the trouble of doing all this, not for an option, but for an actual end set goal of a purchase, a solid purchase. So that is a lease purchase. I'm leasing it now. I'm going to purchase it from you later. And here are the terms. And so just a sample language. Now, again, we are in Illinois. Now, you may listen to this later or see this later in some other state. Talk to your local realtor in your local area. But in Illinois, we're an attorney state. So in an attorney state, attorneys are looking during attorney review. They may be drafting things in advance. This may be a document that you choose to have an attorney draft. But there is a basic amount of language to do a lease purchase. Tenant shall purchase the leased property on or before blank for the purchase price of blank. The security deposit from this transaction, so not a non-refundable move-in fee, because that's a move-in fee, that's gone. But if there's a security deposit in that transaction beginning at the beginning of the lease term, that also then acts in most cases as earnest money for the eventual purchase. And again, remember we said there's a punitive, there's a little bit of a damages if you don't close. It is not refundable should tenant fail to close on this property. That is that's the way we see them most often. It's like the landlord gets the property back at the end, but they're going to keep the security deposit because you didn't keep a term of the lease, which was the purchase, if that makes sense. So again, Illinois, we're an attorney state, attorney review, attorney in general. So consult with your attorney during the process of this. And remember, realtors, you should not be drafting lots of things like this because you are not a licensed attorney. Have the attorney do it. Next idea is the lease option. A lease option, it's similar. You're going to lock in oftentimes the price of the home at the onset of this. However, you can buy it by that date, but you're not obligated. You're not under a contractual liability to do so. In other words, there's probably not earnest money. It's just an option. Those can be written up a number of ways, but I'm going to lease it from you now, and I have an option. I have the option to buy it later. And why would I not want to lock in a price now then? Lock in your terms, lock in your price, but it's your option. I have a lease now, and I have an option for later to potentially move forward with something bigger and better. So you're not obligated to do so, but at your option as the tenant, you can purchase later. So that does lock the landlord in. These are contracts. It's an option at your option. The landlord, if you've written this correctly, and there's a purchase agreement or some sort of terms there, they can't back out later. There could be damages to them or from them that they could be out for. So to do a lease option, you would add language similar to this. Tenant has the right to purchase the property on or before blank for the purchase price of blank. Election of the option shall be made in writing to the owner at the following address. Should tenant choose not to exercise lease option, security deposit to be refunded minus any damages. See the difference there? It's not a slap on the wrist. Oh, you didn't close. You were going to keep your money. Okay, you leased it. You didn't damage it. You didn't close, but that was your option as the tenant. So here is the caveat, and this is where some of my clients have won over the years and I've seen this in commercial transactions as well, is you can negotiate out as the tenant, the tenant's agent, with either one of those, a dollar amount of every month's rent can be deducted off the purchase price, or maybe even towards the down payment or the closing costs if the lender allows it. But there's a dollar amount, there's a reward. Not only are you locking in a price, a sale price, you are getting a reward for actually following through, paying your rent on time every month. And it's almost like a rebate against your rent. So you are getting a little bit of a credit every month towards the purchase price, or maybe even the closing costs, if the lender will allow that, towards the eventual purchase of this building. It's like, hey, I'm getting a little extra credit here for actually following through. So that is a great little caveat if you know to do it. What's a land contract? Well, a land contract is, you see this sometimes with farms, you see this sometimes with businesses. It's an installment contract. You may have heard of it as well. That's an agreement between the seller and the buyer for the purchase of the real property, in which there is a down payment to the seller and then payments monthly to the seller. What does that sound like? The seller's acting as the bank. So in other words, with this type of transaction, the seller is getting interest every month. The seller is actually getting a benefit every month. But also, what are you doing? You're paying down on what? That note. You're paying down on the note with the bank, quote unquote, because the seller's acting as the bank until eventually you refinance this into a real mortgage with a real bank. So a land contract or a contract for deed, I'm going to give you a contract, and that's how I'm going to get that deed eventually. So that land contract is, I've got a contract for this. You are the bank, Mr. Seller. And obviously then there's a little bit more of a recorded interest, potential for a recorded interest. There is a vested interest in the property. The difference also in this is that a land contract, there's normally a significant down payment. When I've done land contracts for people before, traditionally it was 20%, because that's about the amount that they should have probably gone to a bank and gotten a loan for. That also would potentially pay the realtors, the closing costs in terms of all the lender documents, because there is going to be a mortgage note, so to speak. There's going to be a lot of work for an attorney because they're drawing up a legal lending instrument. So the seller is acting as a bank with that. So that is land contract. And again, I'll look at questions towards the end, guys. Thank you for checking into them. So during the period of that contract, so in other words, when that seller is acting as the bank, the buyer's making their installment payments, aka their monthly payments, most likely on the purchase price. They're entitled to possession, equitable title. The seller continues to be liable for anything underneath that. In other words, like if the seller still has a mortgage on it, they're going to probably have to pay on that, or they will better be paying to continue to pay on that mortgage. If there's a lawsuit, basically that gets into some nefarious territory. Well, that's not technically a tenant. That's somebody that's in there as a purchaser. What do we do? Normally that means both the seller or the owner and this quasi-owner are getting sued when there's an issue. So that's kind of why land contracts don't traditionally last forever, is that eventually that seller wants their money, and eventually the buyer wants to really truly own that property a little bit more outright. And because this is kind of like a no man's land of like, well, who really does own it, and who is liable when something goes wrong. So the intent with a land contract in most cases is, yeah, the seller's getting some interest, and that's nice that they can act as the bank, and the buyer's getting the feel of a bank loan because they're paying down on the note every month. There's some equity being built up beyond appreciation, just paying down the note. But eventually it's nice to deal with a real bank, and you're so that a land contract is definitely going to be written up by an attorney, not a realtor, not a client. Don't go to Staples and try to find it. Be careful with that, because a land contract truly is a financial instrument. So I know Bill Bates, Attorney Bates, is on here. He could probably tell you that better than I could. Don't try to draw that up yourself. But it is a out there in the bigger commercial community. There have been some large scale land contracts over the years that successfully eventually closed into a traditional loan, and everybody walked away happy. That is a option out there. So let's talk about an odd duck here. The seller holding a second. And what we mean that is, in some very rare cases, a seller can hold a second mortgage. So the bank's got a first mortgage for 20% down, and then the seller is allowed to hold that second mortgage for part of that remaining loan to value, so the buyer can get in with less money down. That is a very confusing thing, because then it's like, well, wait, there's a bank, now there's the seller holding a note as well. Who's on first? The bank's always on first, unfortunately, except in the case of the IRS or the government, they'll always end up on first. But the seller holding a second, that is a unusual strategy. There's a version of that in the commercial world called mezzanine financing. That's really way over my pay grade, but that is something that's out there. Subrogation is when this is a whole different animal. Somebody is basically leasing a piece of real estate and then subleases it. This is very, very creative financing, where you have seen somebody, I did this actually for a building once, is I leased the building to someone. I was the realtor, and with the permission of the owner of the building, that tenant started subleasing out spaces, and they ran a business of just being like a business incubator. They said, I'm going to create think of it was like before, it was way before WeWork. this is like a me work, is that the guy went in there and he's like, fixed up the common areas with the landlord's permission, spent all this money to say, I'm going to have this like hub of innovation, so to speak, and you can come in and you can rent space in here, and you could be in my business incubator. And the guy did very well, and the landlord was delighted because they got the building rented out, they got some improvements to the building, and everyone was happy as long as everybody was making their payments. So I've seen this with some I've seen people do this unethically and illegally, don't do it that way, where they're renting out, they're like subleasing, aka Airbnb their apartment. That never ends well, guys. But you can be very creative with the landlord's permission if you've got everybody on board. So subrogation is not a seller holding a second. It's a totally different animal. Seller holding a second is like, okay, I'm going to help you out a little bit as the buyer. Subrogation, think I've done something, I'm going to like redo that lease. I'm going to split that up and I'm going to try to get something on top. It's like a layered obligation. So that is very rare. But every time that I've done a creative financing class, something comes up about Airbnb, and someone mentions that, and they're like, well, that creative financing, like, it's not really financing, but subrogation does exist, and it exists in the commercial world as well. So we're not quite ready for questions. We're almost ready for questions. If your only objection or roadblock, remember what we talked about right at the beginning, our only objection or roadblock, if it was truly just the interest rates, you qualify for a mortgage, but you don't want these interest rates, I would say, rather than structuring an entire note based on it, if you can qualify for a regular mortgage, but you don't like the interest rates, let's think outside. Let's think at the edge of the box, not outside the box, but at the edge of it. Because in the late 1970s, especially the early 80s, before, well, I was born, but I was like in diapers. Some of you may have been born, some of you may have no idea when this was because it was way before you were born. In the early 1980s, most realtor boards, I learned this recently when I was studying the 1980s balanced stagnant market with these super high interest rates back then. They had it written into the board contracts, seller will pay blank points. And they weren't like temporary points, it was like permanent points, big dollar amounts that the seller was paying down so that the buyer wasn't getting that massive interest rate. They were getting a discounted interest rate. And that's what points are. So if points are your only objection, your interest rate, the percentage of the interest rate is your only objection to buying, I want to bring on Shaheen, who is a wonderful lender for us and has a huge amount of experience in both the real estate and the lending side. He's an investor. Shaheen, are you with us?
Yes, I'm here.
All right. So Shaheen, talk to us about points. Are they a permanent? You can get a permanent buy down, and how does that work? How do you determine how much that costs?
Okay, so there are discount points which lowers your interest rate, and there's a cost involved with that. It's like, let's say 1% if you're looking to buy, discount point, or 1%, whatever the loan amount is, at least you have to pay 1% of the loan amount. The loan amount is $200,000, so it's $2,000 will bring your interest rate from 6% or 7% to something like 6.625 or something. It's not point to point. So if you're paying 1 point of the loan amount, your rate would go down by 1/8 to a little bit more than that. So but it will be permanent to your note. So that would be your note rate for the next 30-year loan or 15 years, whatever your note terms are. And the buy downs are temporary, which mean that if you're you're paying 1 year buy down, there's 1 year buy down, there's 2 year buy down, there's 3 year buy down, which mean that for the first year, for instance, if you pay X amount of money, your first year buy down will be point to point, which means that if if you have a 200,000 loan and you paid, I mean, we have a promotion going on that we are paying for the first year buy down. So the first year buy down mean that if you have a 200,000 loan, 1% of the $200,000 is $2,000, and if the lender or if the borrower, whoever pays the $2,000, now your interest rate would be, instead of 7%, it'll be 6%, but only for the first year. Or if you have 2-1, which mean for the 2 years you will have, you know, uh, mm, uh, 2-1 means that if it's the first year, it'll be, let's say your regular rate is 7%, which is now, it's a lower, considered lower rate. So let's say it's 8% your regular interest rate. You are doing a 3-1 buy down, which means that you'd be paying 3 points of the total loan amount, and that will bring your loan amount for the first year. It'll be 1% down, and then the next year another 1%, and next year another 1%. So it'll be for 3 years. You can have 1 percentage point lower interest rate, which is a temporary, and it's going to go back to it. However, this temporary buy down is not going to help, because with the DTI, or when we calculate the DTI, then your note rate, we will do it on your note rate, which is the full rate, which is, let's say in this example, let's say 8%. So even though for the 1 year, next year you'll be paying 7%, but the note rate is going to be 8%.
So
So it's yeah.
I just want to interrupt 1 second to clarify for those on this call or that are like listening later. DTI is debt to income, and so
That's correct.
some struggles right now. Let's think back to the conversation. What are your roadblocks? If you're saying I can't afford what I could afford 2 years ago, you're not going to want a buy down. You're going to want to have the seller pay down points. Is that correct?
That's correct. So if the seller, if we can have a seller's the closing cost credit, let's say. So right now, the way our contract says is that the seller is contributing to the closing cost. So in that closing cost, let's say seller is paying $10,000 for the closing cost credit. From that 10,000, you can buy a discount point. So let's say you buy 1% or 2%, that would permanently lower your interest rate. However, like, it's not 1-to-1 ratio. So 1 point, the buy down from the seller's closing cost credit will buy down 1/8 to maybe 1/4% of your rate, which will affect in calculation, it'll affect a lot. If you could do it 1/4% or 0.5%, this will make a lot of difference in the payment.
So I just learned, Shaheen, thank you so much for that, because I just learned a whole bunch. I actually had to get you guys saw me like trying to find a pen. I have never in 25 years fully understood the difference between points and a buy down. Because literally, I even in these slides said use the word points and buy down. Those are not interchangeable, guys. There's a big difference between them. So points, that's a permanent thing. A buy down, it's bought down, but it could go back up. It will go back up.
Yes.
The DTI, debt to income, that payment amount, it is really going to be the points, not a buy down. And Shaheen, do you think the best person to have that conversation with, not even the agent, I think the buyer and the lender and the agent, they've got to understand, the agent's got to understand how to write this up correctly. But I think that buyer and their lender have to know how much that's going to be in terms of a cost, because most agents and sellers are not equipped. Like, if you just put 3 points, what does that mean dollar wise? I think that's going to be valuable for the lender. For those of you that are clients on here, we need, your lender needs to be versed in how much points are going to be, how many points are allowed, And then what's the cost? So then that way we can write that up appropriately. That I
Correct.
really
So,
don't.
so in the contract, we don't write the points, discount points, but at least we can write the credit. For instance, 10,000 credit. Out of the $10,000 closing cost credit, we can use, let's say, 6,000 for a discount, for the discount point to lower the interest rate. And then the lender has like a chart where it says, okay, if at this point, if you pay this much, your rate is going to be this much, and if the discount point is like 2%, your rate is going to be this much, and this is a chart that your monthly payment is going to be this much. So that's something the lender will provide you, or your loan officer will provide you when you talk to the loan officer, saying, okay, if you buy, you have $5,000, $6,000, or $7,000 in a closing cost credit. How can you convert that $7,000 into a discount point, and what is going to savings per month to me, and what is going to, how much lower my rate is going to be?
Well, that's great information. So Shaheen mentioned this casually, but there is a 1% 1 year interest rate buy down. Now we've learned how to say the difference. 1% 1 year interest rate buy down that is he's offering at no cost to the seller or the buyer. That is on Starlight Mortgage. And all you need to do to get Shaheen's information and to apply online is to text the word financing, just the word financing, to the number 85377. So financing to the number 85377, and you will get taken to Starlight's website. You can apply online. You can converse a little bit more with Shaheen on that. Shaheen, thank you very much for explaining the difference to us. And for everybody, I think we're all going to probably be looking at points as a conversation in the near future. If we're not doing creative financing, we're going to do a traditional mortgage. That's going to be the way that we can get these interest rates down, and not be on an adjustable rate note or some of this other stuff that's out there that we don't even have time to talk about tonight. But Shaheen, thank you so much for being here with us and clarifying that for us. So we've
Sure.
some other questions here. Cassandra wanted to ask, how would you overcome the barrier of having that discussion? In other words, the discussion about creative financing with the listing agent. Honestly, you might have to send in these slides. Some listing agents have never heard of any of this. And that's why I wanted to do this class as quickly as I could get it on the books for us, because the minute I started researching how long this could be, this balanced stagnant market, and how high these interest rates have gotten lately, I realized that we are going to start having these conversations. So somebody that's not been around a long time is going to have no idea what this is. And so you may need to educate them. Feel free to send them this video. If they are working, on a property that Exit Strategy has a buyer for, or a creative financing buyer for, wrote me into the discussion, and everybody here knows how to get a hold of me to set up a coaching session. More than happy to do that. And you will, I believe, Cassandra, it's a great anticipation of that roadblock. You're going to probably have to educate that agent if they've not been around a while, because it's not their fault. It's just we haven't been talking about this in so many years. So then Bridget had a question of, with the lease purchase and it comes to the purchase of the home, is the earnest money still non-refundable if the deal doesn't make it through AI? Bridget, that's actually a great question relating to, in general, if you're going to go buy a property, or you're going to go do this creative financing to buy it, when do you do that inspection? Here's my take on it. Doesn't have to mean that you agree. Talk to your attorney. But I would say that if I'm going to, maybe not with the lease option, but maybe even with the lease option, if I'm going to put my deposit, my security deposit towards this place, and I'm going to say I'm going to lease now, and I'm definitely going to purchase it later, why would I not do my due diligence up front? A home inspection is, I don't want to throw a number out there, but several $100s. I don't want to minimize that dollar amount, but I'd rather know on the front end that if I'm going to truly start treating this property as my own, because one thing that in these slides I rushed past in my excitement to get to the good stuff, but a piece of it that's a benefit to sellers and owners, going back to Cassandra's question about educating the agent. I'll tell you, some of the best kept up tenant properties are the ones that the tenant thinks they're going to buy or is trying to buy, because that is where all of a sudden I've got almost like a homestead. I've got an equity feel to that. So I don't want to start feeling like I have equity or start treating a property, in terms of like starting to do improvements. I have had that happen on some of my creative financing deals where the tenant started to do improvements. And if they're not able to get that mortgage later out of their own fault, most cases, even though there is a financing clause, that is not part of that original lease conversation. You didn't close. But to go to Bridget's question, I would say get the inspection done up front, and then your lease purchase or your land contract is null and void. Basically, that deal is dying because it didn't make it through the inspection. Because your then question would be, well, am I still going to go forward and lease this property knowing I don't want to buy it? And that's got to be a conversation between everybody on the front end. Is if there is a security deposit or a in the land contract, that down payment on that contract for deed is non-refundable. So unless there has been an inspection on the front end before you get into this document or before you get into this agreement and money has changed hands, you may want to get that inspection up front and spend that due diligence money, because everybody involved, I think, wants a solid deal. It's the way I advise my clients, even in short sales. So I appreciate that. Great. Those are great questions. All right, guys, we're over the hour mark. Does anyone else have questions for me, for conversations about any of this stuff that didn't make sense? Well, you guys know I'm just a quick appointment away. If you're an agent of ours, and if you're a client of any of our agents, we coach together regularly as a group and one-on-one. And whoever brought you here this evening, make sure to get on Zenlist with your Exit Strategy Realty agent. If you want to come on Wednesday evening, just text Exit Strategy Events to the number 85377. If you don't know what your roadblocks are yet, and I'm going to take us home this way. If you don't know what your roadblocks are, credit, income, money, don't just come on Wednesday night. I would also say, talk to your lender. We just talked to Shaheen here. You text financing to 85377 if you want to talk to him. And if you need a reason to commit, just remember how much I paid in rent to my old office landlord. And you don't want to do that in the home you live in or in a property that you could have purchased, whether you are a business owner or a property tenant. So thank you guys very much for being here this evening. We will see you hopefully out on Wednesday and at the balance of our events this month. Have a great evening. This has been recorded and will be on YouTube shortly. Bye-bye.